Hello and welcome to Business Today Television. I am Siddharth Zarabi. On the show today, we will discuss the mutual fund industry. While the liquidity offered by mutual funds is a virtue, has it been oversold, and has it been oversold to the extent that investors are buying and selling on a whim? This is important given the average life cycle of a SIP in an equity fund is measured to be just 2.5 years, even when industry experts say that the ideal time horizon to hold should be 5 to 7 years. So what is the ideal time to hold a mutual fund SIP, and what is the future of this business? For more on this, I am joined by DP Singh, the Deputy Managing Director and Joint CEO of SBI Mutual Fund. SBI Mutual Fund, viewers, is India's largest fund house by assets under management. Welcome to the show, Mr. Singh. Let's first discuss one of the key numbers, which is industry data, and the data suggests that as far as the industry is concerned, there's been outflow if we see data up to the month of October. What are the reasons for this outflow, Mr. Singh?
Basically, outflow is for two reasons. One, you have already explained in the initial time, the people who have been collecting money over the period of time in SIPs. Somehow, over the period of time, they feel a little fatigued, and they feel that we have got such a good return. Why not to book profits and sit on the sidelines? So that is the biggest problem with the industry, is that people 16, 18, 20% return. Sometimes they feel that this is a good time to book profit and will time the market and get into the market when it goes down again. So that is an issue. That is number one. And number two issue is the withdrawal from the debt category of funds. See, post the tax law changes which happened in the last year, where the indexation benefit to the mutual fund investor has been withdrawn. So people are booking profit, getting the money out and looking for the alternate asset classes or alternate assets. So withdrawal from the debt funds is huge, whereas in case of equity funds, net, because we are getting around $2 billion every month through SIP route. If we look at that number, even that number should have got us almost 1,28,000 crores of net sales. But the equity net sale is 1,02,940, as is evident in the screen also. So that means net we are negative on this thing. So whereas so many NFOs have come, but the actual whatever growth we are looking in the equities is basically because of the mark to market, because markets have gone up.
Correct.
So there's one set of people who are getting in, and there's another set of people who is getting out. And we have also seen those cases where SIP is continuing, but the collected money, whatever has been collected during the last 2-3 years, that is getting withdrawn, but the SIP is continuing. So those are the behavioral issues rather than any technical or this. I think investor education has to play much bigger role from here on, because the concept is sold, but the nuances of the concept has to be taught now to the investors. That is very important.
That's a very important point, and I'm glad you're pointing this out, because here at Business Today Television, we also spend a lot of time on trying to give the best possible information. Since we spoke about SIPs, Mr. Singh, on a lighter note, the way I define SIPs is, it is a good way to save, invest and prosper. But the issue here is that many people, instead of doing this sip by sip, like you said, are perhaps being driven by certain factors to cash out early. 2-3 questions here, and I'll try and take them one by one. Is this a trend that has been seen in the recent past, and therefore is it correlated with some of the economic pressure or job loss and other underlying trends that we are seeing?
No, it's not that. But what we have seen is it's seen in the recent past because of the reason that fintechs are getting a lot of transactions. The fintech companies, they are in the selling mode. They do direct. They don't have any motivation of educating people to be there. Most of them are coming in the direct plan where there is no remuneration. Their mere motivation is to get more and more number of investors. The quality of money which stays there or the how many months they stay there is not a motivation to them, because all these are the most of these are funded unless until there's a motivation for the fintech company to keep their investors invested for a longer period. I think it will continue to be like this. So there has to be something else which we need to do. This is something, some innovative uh, thing has to be done, so that people who are coming through in fintech also are staying in the market for a longer period. Especially the youngsters, they are putting money for a short period. Luckily for them, the market is moving on the one side. So even if when they're making putting in money for 6 8 months, 1 year also, generally they are making money. But these are not the things which happen all the times. The moment they will burn their fingers when the cycle turns, that will be something where will people say, "Okay, no, no, we did a bad thing." So we don't want them to learn the lessons hard by getting into that cycles and then learn it. We want them to learn it much before that happens. That's important, that at what point of the cycle you are making the investor education, proper investor education is being done.
Uh, uh, since you spoke about fintechs, and this is a very important point, fintechs and the ease with which they interface with customers, coupled with digitization, digital interfaces, handset-based transactions, there is an impact we are seeing in the lending space also, Mr. Singh, but that is a separate matter.
Yeah.
What would you tell those younger generation of investors who are using fintechs and the technological ease of investing that is being provided, that while they use technology, they should not be fickle? What would you tell
Yeah,
them? What
yeah.
should their ideal
No,
behavior
no.
be?
My simple suggestion or advice will be: please remain disciplined, have long term goals in mind, and don't put money in equities for a short term goal. Short term goal till now, for last few years you have got a positive experience. Don't take it for granted that you always will keep on getting a positive material, because we have in SBI Mutual Fund, we are there for last 35 years. We have seen different cycles. We have seen 2000, we have seen 2008, we have seen 2016. The cycle when they come, the problem is whenever somebody burns a finger in a bad way, then that generation doesn't come back into the market for a decade. So that's something we don't want. We want them to remain invested, remain happy investors, and be disciplined, and don't get into the riskier asset classes for short term. That is where the question of overselling the liquidity is coming, because there is hardly any exit load. There is hardly any this that you can't do it. We have to provide liquidity and let the liquidity be available at a cost, or with some discipline, or maybe there should be some exit loads, etc., which needs to be brought in.
When you say there should be exit loads, as the largest fund house by assets under management, am I to understand that this is something that you are already speaking to various authorities about, or is this just a thought that you are
No,
floating?
this is thoughtful in the industry body. We will discuss about it. We are not, since we are the market participant. We'll go with the norms of the market, whatever is happening in the market. But this is a responsible kind of concept which we need to sell internally first, then coming out in the market. As of now, there's no such plan or no such discussion happening. But this is, since we are discussing, so as an individual, I this is my personal view, that this is something which may be good for the investors to remain disciplined. But what happened, we are B2B. We are basically an intermediated market. any intermediary will not like this to be there. So they will generally sell. When even the investor will say, if there's fund A and fund B, fund B is not A is not having any exit load, and fund B is having 3 years exit load. So naturally, the more tendency of a normal investor will be to go for fund A. So, but we have to bring in a consensus. We have to sell the concept, and we have to be the investors to understand what is good for them in long term.
One of the questions that Gen Z investor might be asking while watching this, he would ask two questions of you, Mr. Singh, and I'll try and articulate it on their behalf. Number one, where are we in the cycle? Because you spoke about cycles in the past, and suppose someone has come in last year or this year and has a 5,000, 10,000, 15, 20,000 SIP that is underway. How should he approach this? Because we have been consistently showing on our screen, as you would have noticed, that the ideal time horizon should be 5 to 7 years.
Yes. No, my point is that let the overselling of the sectors, this sector, or this cap, market cap, mid cap, small cap, or large cap. So generally, people get convinced with that. Our theory is we have to look at the good businesses who have got the visibility of good returns over the period of time, good growth over the period of time. So everything comes in percentage terms. A good large cap company which is having a very excellent growth opportunities, and there's a visibility of growth, may be much better than a small cap company which may not be having a very good growth trajectory, and which is not into a particular business which may grow or may not grow, kind of thing. So that's what we want to say: a diversified fund, a multi-cap kind of fund, or any other kind of flexi cap kind of fund are very good, rather than going into small cap, because small caps will give you better returns. Of course, small cap funds have given better returns over the period of time, but there's always a cycle. Sometimes mid caps do well, sometimes small caps do well. It's always good for a normal investor to remain into a diversified fund.
I don't know if anyone has come and told you this, but there have been two things that I have noticed in the recent past, particularly after the sort of digital wave post-COVID. One, that a lot of youngsters seem to prefer direct equity, because it could be that they expect higher rewards, and because they are able to take much higher risk. And when you tell them about SIP and mutual funds, some of them find it a little too boring for their risk capacity. Is that something that you have also noticed?
Yeah, we have noticed, because there's always a human tendency, or what you call, since we are in a very sweet spot as far as economy is concerned, and globally we are doing well. So what youngsters or Gen Z is doing, oh, Khelo India, Khelo kind of thing, that let's play in the market, let's have a little more risk. So as I said, we since we are a long-term player and we have seen different cycles, we always keep our emotions in control. Whereas the people who are joining the bandwagon just now, they may become very emotional, and sometimes they feel we are so good at picking up the stocks, that we have made so much money that people may not be able to do it. The mutual fund may not be able to do it, but mutual funds are long term. Mutual funds are very research based. Today we have got 65 members investment team, if I talk about SBI Mutual Fund. And all of them 24/7 are researching the companies and looking at the growth trajectories, looking at their financials, looking at the management quality, what is going to be the competitive edge of that. Only then we get into the businesses. And see, a layman generally look at the how the market, the particular stock has fallen down, now it will come up, kind of thing, without having any such. Some of the people are really smart. Huh? Let me tell you. Let me be very clear that some of these youngsters are very smart, but that smartness as of now is looking, and they are doing very well. But over the longer period, since all of us are busy in our own areas, right? When we should not, we don't have the time to put in the research of particular company, so on and so forth. So with the cost which is there in the mutual funds, I personally feel even if you have some tendency to do direct equity, let it be apportioned amongst mutual funds and the direct equity. The surplus which is there for long term goals, let it be there with the mutual funds, and anything which you are doing for the short term, let it be done by you, so that because mutual funds will never get into the short term gains kind of thing. They will always look at the long term.
Absolutely, and it's a well understood point in the market that everyone is a rock star when there is a bull run, but when the bears come, then people don't know where to hide. Two
Yeah.
points here. As far as the mutual fund industry is concerned, do you think there is further scope to look at the cost and make it more sort of provide higher returns to investors? And the second thing, in terms of the complexity of products sold, do you feel that is also a hindrance to get a newer class of investors into the mutual fund investing scheme of things?
Yeah, I'll take it in two ways. There are two asset classes basically. There's a one debt mutual fund, and there's a equity mutual funds. If you look at the debt mutual fund, the costs being charged by the industry by and large are much lesser than the which is being allowed by the regulator. On a weighted average basis, I think it will be 40% or 50% what is allowed. So that is something, that is the cost which has been done. This has been come because of the competitive environment and the keeping in view the net returns to the investors. So that is something which is happening in a very good way. As far as equities are concerned, again, equities are, you have to put it in two ways. One is passive and one is active. Passive, we are amongst the cheapest, not amongst the cheapest, but the cheapest in the globe. If you look at it, the weighted average cost on the passive funds will be around 10 to 12 basis points, and globally, even the funds which are 10 times 20 times bigger than us, they are charging on an average 25 to 30 basis points. So we are already at a one third of the cost. That is number one on the passive side. On the equity side, the regulated costs are such that which is graded with the markets going up because of mark to market or otherwise. If there's an automatic system of costs coming down. Again, on the active side, we are the cheapest on the, especially on the direct plan. There's no country in the globe which is charging 50, 60 basis point to the investor on a equity fund, active equity fund. So that is the kind of situation where we are. I don't think there's any further scope, because any further scope will mar the expansion of the market, will mar the capability of the fund houses to go and get in more intermediaries, because ultimately an intermediary is managing a very small portion on an average basis. At today's price, if a retail intermediary is having a AUM of 5 to 7 crores by 200, 300 investors at the cost of 2 lakh, 3 lakh rupees. So his total income in the whole year post income tax, post GST will be less than 3 lakhs rupees a year. So that's the kind of, I mean, on an average, I'm telling. So if we are not giving the proper remuneration to the distributor, then we will be suffering, and we are already suffering. By the way, just to give you a number, the number of intermediaries who are selling insurance products today in the country are more than 2 to 3 million. Whereas the number of active distributors in the country of the distributors of mutual fund are less than a lakh, less than 1 lakh. We need 20, 30 times more distributors, and they will be able to come, they will be able to take the industry to the next level. They'll be able to take us, take the penetration from the existing just 4% to 10%, only if they are properly remunerated.
That's
Any
a
further hit on expenses will mar the expansion of the industry.
That's an important point because data seems to suggest that mutual fund distributor earns just 8,000 rupees on an average on an equity AMU of 1 crore rupees. So obviously the point
That's
that you,
yeah.
no, please
One
go ahead.
one crore rupees on rupees 8,000 rupees per month. You are saying that's
Absolutely.
fine.
Yeah.
Yeah. That's right.
Before we wrap up this conversation, I want to dwell on one more point, and this is to do with the broader situation that our markets seem to be in. You are a veteran of the industry. What's your own sense about how the overall trend is shaping up?
The trend is, see, one thing is very clear. The total overall savings and investment, there's very thin line. One thing is very clear, the normal investor, normal saver who is having a surplus of say more than 10 lakh rupees, understand this thing that if he has to optimize his return, he has to be into the savings and investment in a balanced manner so that there's some portion of investments which should give a kicker to his overall returns. That is something is very clear. Because concept, as I said earlier, concept of mutual fund is sold. Now nuances and push has to be sold in a proper manner. Though people, there are so many people, forget about the smaller towns, even in the larger towns in Bombay and other area, Mumbai, Delhi, there are so many people who have yet to start their journey into the mutual funds. Huge number is still there. So there is a need of a proper ecosystem. Digitalization is one, but there are so many people. Ours is such a huge country. Everybody is not a digital savvy person, or even if it is digital, somebody has to handle. It has to be physical. But for that physical thing, we need to have a proper intermediary base, and we are trying to do that. A regulator also has given some incentives like there's a regulatory sandbox kind of thing which has been given, but we need to fine tune that because whatever has been given has not been accepted properly by the market. We have not been able to make any major difference. So maybe we'll discuss internally, we'll discuss within the industry and with the regulator so that we can attract more number of people who are selling mutual funds.
You mentioned during the conversation about Khelo India, Khelo kind of mindset, and we saw that even in the cryptocurrency fad when it was happening.
Yeah.
But I'm
Yeah.
also wondering that India is also still, and you will agree with me, Mr. Singh, still to a significant extent a nation of fixed deposit investors. You know, if you look at the overall fixed deposits versus a mutual fund, there is still scope to go. So a final word from you to those who believe that fixed deposits are more safer, more secure, more dependable than mutual funds. What would you say to them?
You see, there will always be a set of people who will believe in bank deposits, and bank deposits and investments always will go hand in hand. That's what I exactly said. There has to be a proper mix of saving and investment. That is what, because the overall liability business in the country has to be deposit plus investments. It can neither be only saving nor only investments. So there will be people, retiree people, or people who are surviving on the returns on a particular time for a particular period. So they will continue to have faith in this thing, and nobody can stop that. And especially there are cycles in the market. For example, last 1 year, there have been instances where the short-term mutual fund schemes in the debt category have been generally giving lesser return than the bank deposit rates. And bank deposit rates were higher because of the overall cost of funds were cheaper, and there was a credit demand. So banks were offering very attractive. Banks are still offering very attractive fixed deposit rates. In such a cycle, deposits will always remain in demand. But over the longer period, if you are talking about the long-term wealth creation, there debt funds and equity funds or mixture of that, the hybrid classes have come, which have come in a long way. So that will continue to attract customers. So we can't. There's today, for example, 5 years ago, rather 3 years ago, the mutual funds were 18% of the bank deposits. Today, within 3 years, the mutual funds have become 24% of the bank deposits. So the journey of increasing penetration of mutual funds and less attraction towards bank deposits, that journey is visible. And if you look at globally also, there are economies where mutual funds are more than 100% of the bank deposits. But there's no economy where everything is in investments or everything is in deposits. So we are in the growth trajectory where mutual funds are growing, and this will continue to grow. And this growth has come two ways. One is because of the net flows, and the second is because of the mark to market movement of the existing investments only, which have grown. Because bank deposits on a standalone basis will grow at 5-6%, which is the capitalization of interest. But in case of mutual funds, if the market is moving up and we have got 40-50% in equity assets, our average growth will be around 11 to 12% on standalone basis without taking care of the net flows. So that also gives us a heads up as of now, because market is moving on one side. But yes, I agree with you. Over the period of time, I can foresee within next 3 to 5 years, we should be almost 40% of the bank deposits. That's where it looks like.
Well, that is a important number, almost half of the fixed deposit base to be mutual funds in next 4 to 5 years. That's an important data point that you offer. But Mr. Singh, from this conversation today, those of who you have watched, it's very clear. Investment is a long-term game. It is a game that you obviously do not play completely blind. You have to be conscious of risk. You have to allocate different amounts in a portfolio across a class of products, and mutual funds, as is clearly visible, are becoming more and more preferred and hopefully will remain so. But there are certain things that you need to keep in mind, and that mindset of buying and selling on a whim may not necessarily apply to mutual funds. It's not day trading, viewers, and you should be aware of the risk. Mr. Singh, thank you very much for your time with us today.
Thank you.
With that, it's a
Thank you,
wrap on
Siddharth.
this conversation. We'll be back with more.
Thank you very much.
Until then, goodbye.